Studio by Earl Davis, who's head of fixed income and money markets at BMO Global Asset Management. Earl, it's nice to see you. It does feel like we've had a new dialogue emerge over the last few business days because we had a Bank of Canada interest rate decision to digest, and the message from that, we've had inflation readings in the U.S. that have been hotter than expected after a strong jobs report in the United States a week ago. Are we talking about a tale of two markets right now?
We definitely are. It's the tale of divergence. But what's interesting about the tale of two markets, we always have to remember the U.S. is the tide, Canada is the wave. So the general direction of the U.S. for interest rates will definitely, as we've seen this week, influence Canada.
And so what do you think are the main differences between the two economies at the end of the day?
Well, the deficit spending, for sure, in the U.S. That is the main stimulus supporting businesses in the U.S., and that's starting to not only be resilient, but re-accelerate, which is a very strong word.
And obviously, we've had, we've got a federal budget in this country next week, and we've had a lot of spending, but I think this interest rate environment also has complicated the story for Canada's deeply indebted households. We have a shorter duration mortgage market. Does that factor into some of the differences as well?
It does in regards to, because of the shorter mortgage in Canada, we have less disposable income as compared to the U.S., where they had 30-year mortgages at very low rates. So it definitely factors in. And that's part of what we're seeing in that divergence. We're seeing a divergence of spending, and we're seeing a divergence in employment.
Okay, so that's one of the differences. You talked about the impacts from spending at the government level in the U.S. to stimulate the U.S. economy. So what ultimately does this mean in terms of interest rate policy, in your opinion? I just talked about what some of the markets are thinking for both Canada and the U.S. this year.
I'll start with Canada. It definitely eliminates hikes, because we always thought there could be a probability of a hike based off the U.S., and we still think there is in the U.S. What it says, it's eases or no cuts. For us, our base case is eases. The market right now is saying 60% chance that starts in June. We believe it's September. And we believe that for two reasons. One is because of the strength of the U.S., if Canada eases in June, the currency will weaken even further, which actually is stimulative from an inflation perspective. A weaker Canadian dollar means it's more expensive for imports, which means it's inflationary. And Governor Macklem at his conference said we do take the currency into account. So that's important. We don't think for that reason. And then there's a domestic reason, which is in the money markets in Canada, we are losing the BA market. You know, there's a long story behind that, but that's $90 billion of product we don't have, and that comes June 28th.
And can you just explain what that market is?
So money market is 1 year and under investments. It's typically dominated by two investment choices, three. One is Canadian T-bills, out to 1 year. The other one is commercial paper. That's 1 year and under product issued by corporates, the equivalent of a corporate bond, but 1 year and under. And the third one is bankers' acceptance notes issued by banks. That is $90 billion of product that will no longer be in the market as of June 28th. Because of that, we expect a significant imbalance in supply and demand for short-end product that could be exacerbated if the Bank of Canada eases in June. So we think that's a consideration from a financial stability perspective, at least for the month of June. We just think it's a 1 month phenomenon until this transitions out.
For anybody who's just listening or having their morning coffee, just to reiterate, at a time when everybody's constantly obsessed with charts on inflation, which are important, you were saying the timing for a Bank of Canada pivot towards rate cuts will be determined in part based on some stuff happening on Bay Street, the fact that our Canadian currency is already weakening against the American currency, and while that's good for exports, it complicates the inflation story. And then the other one we haven't talked about, but some guests have definitely talked about, is that because we've got such a tight supply-demand story for our housing market, a lot of people have been waiting for the opportunity to move into the housing market based on interest rate policy. And there is a concern out there that when the Bank of Canada moves on rates, that ultimately there could be some inflationary forces at play through higher home prices. Is that another leg of the stool for you, or less so?
It ultimately is. There's a lot of truth behind that. The thing that's not taken into account is that is more determined by the 5-year rate. Your 5-year Treasury or Canadian bond rate determines that, because most are 5-year mortgages, not variable. The 5-year rate has a large influence is the U.S. market. That's the tide.
Okay, so at the end of the day, these are some of the differences to watch, particularly when it comes to when there is a pivot. But there is a need for a pivot in Canada at the end of the day, just because of the weakening of the economy, or?
You know what? It's not the weakening of the economy. It's the weakening of inflation. Our economy, they've actually upgraded their forecast, the Bank of Canada, on the economy. That is not because of domestic reasons. That's because the U.S. is doing so good.
Yeah.
You know, U.S. sneezes and Canada catches a cold. That works both ways in down markets and up markets.
Do you think the malaise some feel on Main Street these days is more a reflection of the inflation story then versus, I mean, because our unemployment rate has been trending higher recently, north of 6%. If you think that I get the headline story of a resilient economy helped by the U.S. economy. You just don't always feel that on the street these days.
You're 100% correct. The malaise is because of inflation. People feel it every time they go to the grocery store. People feel it every time they fill up their gas tank. People feel it when they order food or go to eat out. We're all seeing higher prices there, and that comes out of disposable income, which is much more evident, and we feel right away.
Okay, so at the end of the day, you gave us that first taste of what you think the roadmap looks like for Canada versus the U.S. Just to finish home the point, heading into, call it 2025, first quarter of 2025, what do you think the rate environment looks like? The Bank of Canada, in your best guess right now, has officially pivoted by that point. What have they done on rates? What has the U.S. done on rates?
So a couple things. I like to say this is why I believe active management is extremely important here.
Okay.
We have a lot of different dynamics and stuff.
Sure.
So all else equal, and I'll come back to what's not equal, but all else equal, we expect rates 1 year from now to be lower across overnight rates, 5-year, 10-year, 30. What makes it not equal are two things. One is the election in the U.S. There could be a significant impact on the outcome based on the outcome there, which we'll get in November. The other one is 2025 is an election year in Canada. There could be more stimulus that comes down the pipeline that could push out things.
Right. And we assuming it's not this fall, we're having an election in the United States and Canada as well. But the reason that the political dynamics matter in things like rate policy is what?
The fiscal stimulus. Deficit spending is stimulative to the economy. And that is significant, as we're seeing in the U.S. So that's why the implications there are important. I'm going to bring up one other one with the U.S. I think both either Democrats or Republicans will still be stimulative to the economy. But if the Republicans come in, there will be a big deregulatory move, which adds further stimulus to the economy, because then small and medium-sized businesses invest more because they have less regulatory costs.
And so if that spending is playing out, that actually can make it more challenging to cut rates if there's an inflationary force from that spending?
Well, it's not, yes, but it's not just an inflationary force, it's a growth force.
Growth force.
Part of why they've upgraded Canada in the NPR statement was because of the U.S. The U.S. is doing so well, we do well.